It's Mike Conlon here at FXEDU. I'm going to start the webinar in about a minute or so. I'm just going to wait for that official 9 a.m. start time here in the U.S. for us. But this morning, first segment of the featured monthly webinar here at FX Street is going to be on something I'm going to call low-risk trading. And it's going to be interesting how we're going to define that because, it's actually sort of an open definition. What's low risk to some folks may not be low risk to others. So let's get this thing started right now. What we're going to look at today is a couple different ways that we can place trades that I'm going to classify as low risk. Now, you may be asking yourself, well, what is a low risk trade? And in my eyes, a low risk trade is any trade I can get into that has technical merit to it. Perhaps there's a fundamental bias to it. But it's going to be a trade that I can get into with a very low risk as far as what the pip amount is that I'm willing to lose. And usually how we're going to take those trades is by attempting to buy ahead of support, attempting to sell ahead of resistance, attempting to use some technical indicators that'll give us a more clear picture of what's going on. So for the next hour and a half, we're going to examine what's going on in the markets. So if you have any questions, by all means, put them in. I'll try and answer them as we're going through. We'll attempt to take a look at some different things as we're going on. Now, we've got a quick peek here at Euro USD, and it looks like we may be setting up here for possible reversal here. Now, you can see that the minor trend is down. Okay, we had a test here of 143 earlier. All right, we get this nice, looks like a gravestone doji type candle here before we've sold off a bit. So we're putting in what looks like hammer candles here, dojis, so we may be getting ready to potentially reverse this trade. I've got a stochastic setting down here, 553. I'm on the 5-minute chart. I've got a standard Bollinger Band setting, a 22, okay, and we're going to try and take a look at what's happening. So, right here we're pulling back. We're just ahead of 142. You can see earlier this morning we came back, sort of tested that area, and now it looks like we may be willing to push higher. So it's 9 a.m. here in the U.S., and I'm looking at this trade here, and I'm thinking, okay, this may be a decent potential for a reversal. All right, what we could do in this situation is we could potentially buy this thing right here, 142.30. We could put our stop just below that low candle, just say 142.25, and that would be about a 10-pip risk, which for a day trade is actually pretty good. All right, if we could get a bounce back up to the middle band, the 142.50, all right, that would be about a 2-to-1 risk to reward. So, yeah, let's do it. What the heck? All right, I'm just going to go ahead and I'm going to take one little lot, or let's take two little lots here, and see what's happening. Okay, now what I've done is I just went ahead and boom, we just bought some right there. I want to place a quick stop just below at about 122.20. I've got about a 15-pip risk on this trade, which, for me, that's what I'm going to consider low risk. Now, some people may say, well, wait a second, the minor trend here is down, and we're going to look at the overall trend, which I'm sure that we're all aware has been down over the last couple of days. Let me just get my stop in here as I'm speaking. I'll put it at, say, 23. All right, we're going to look at about a $25 loss if that thing gets hit. All right, so let's see what happens. So in any event, getting back to the idea of trend, okay, we're going to take a quick peek here at the 30-minute chart. And as you can see, we've been in sort of some sideways action recently. If we go back a little bit further, let's just look at the daily for kicks. All right, you can see that the trend has been down. We were in an uptrend that had happened. All right, we break through the 20-day moving average here, and now it looks like we want to go lower. All right, so there's probably, in my eyes, going to be a test of, say, 140 here fairly soon. So, we'll have to take a look at, what's going to happen. But for right now, what we're doing is we're doing a little bit of day trading. And in day trading, we know that, the trend can be up, it can be down, it can be sideways, and these can all happen within the course of the trading day, regardless of what the overall long-term trend is. Now, we're going to take a look at some longer-term trades as we get sort of moving, but I just want to give you a little bit of background, kind of some of the things that we're looking at, some of the ways that we can place these trades, because, in my eyes, it's the kind of thing where I've risked 15 pips on this trade so far, And, whether or not it actually, wins, obviously I want this trade to be a winner, but, when I can get into a trade with about 15 pips of risk and I think that there's potential that I can retest the highs of the day, all right, then that's going to be a good proposition for me. All right, because I know that the average true range of most of these pairs is around 100 to 125 pips a day. So there's going to be a lot of movement in there. And when you get a lot of movement like that, all you need to do is capture little pieces of it. Okay, you don't need to take this thing top to bottom or bottom to top. And, you're going to be able to make some profit. So, let's see. All right, Dan. So Dan got into the trade about 15 minutes ago. That's, all right, Dan. I like it. It looks like, 15 minutes ago. You're a little bit lower than we are. Let's see here. How often should a trader check the trend, longer time frames? The question from Harley, how often should a trader check the trend or longer time frames? Generally speaking, you want to get an idea of what the overall trend is, from a longer term perspective. I usually check it once in the morning. For example, I didn't need to check the trend to know that Euro's been down as of late, that we've had a little bit of dollar strength. But as you can see, you really need to define what the trend is. All right, trend can be on a short-term trade on a 5-minute chart. It can be intermediate on, say, a 30-minute or a 2-hour chart. And then lastly, we can have a longer-term trend on, say, a 4-hour or daily chart. So you really need to define what, trend it is you're looking at it. And usually that comes in with what type of trades you want to place. Okay? If you're somebody who is more of an intraday trader, all right, then you want to look at the shorter-term charts. If you're someone who's a longer-term trader, you want to look at the longer-term charts. So, that's kind of, how I'm looking at it and what we're looking at today. But right here, I still think 142 is going to be decent support for the euro, and there's possibilities that we may get stopped out on this trade, which, if it happens, so be it. We're going to be looking perhaps to find another entry where we can get back in from either get back into the long side or potentially short. Okay, maybe a short at 142 is going to be in order. So just real quick, I just want to kind of tell you what's been going on this morning so far with regards to the news that we've seen out there. U.S. initial jobless claims, they came in a little bit better than expected. Excuse me. The lower end of 400,000. The expectation was about 420,000. So it's a little bit better than expected, but it's still not a great number. I mean, I think anything in the 400s the market's viewing as negative. All right, but yesterday we had the release of the minutes of the FOMC meeting. All right, and they've sort of said or made it known that they're in no rush to exit this QE2 policy here. So, yesterday we saw commodities really take off. We saw stocks rebound. All right, and people are thinking, hey, wait a second, this U.S. Fed's going to be accommodative for a while. All right, now we've also got supply and demand factors coming into the equation with regard to commodities. All right, supply, there's been some supply disruptions based on some weather-related stuff going on that's going to potentially force prices higher. And on the second half of the webinar this morning, all right, I'm going to talk about correlations in the marketplace and how you can sort of get a gauge and an idea of how some of these things move based on what, some of their corresponding and correlated commodities are doing. So a lot of different movers that can drive commodity prices. All right, and sometimes we'll see either the currencies follow, perhaps stocks follow, or vice versa happens. Maybe stocks and commodities follow the currency. So we're going to take a look at that a little bit later on. So right now we're still in this trade. It's still valid, and again, low risk opportunity because of the amount of pips. Now, a lot of times when I get into trades, I want to ask myself, well, what does the probability of this trade seem like? Is there a high probability that this is going to be a winning trade? And that's going to sort of be, something that you have to determine for yourself, and it's going to be, through the course of your own trading, all right, and the different setups you use, what are things that tend to work more than others, all right? Now, this trade that we're looking at here, this doesn't look so hot right here. I believe we're going to be stopped out shortly. All right, but it looks like we are in that oversold area, and should this hold, which I don't think it will, perhaps we're going to be looking down at the next little support level around 142. All right, so we're taken out. We lost 12 pips. We gave it a shot. Whoops, and we're down $25 on the morning, which, that's okay. We're starting out at 9 a.m. here in the U.S. We've got U.S. stocks opening at 9:30. And then the other piece of news that hopefully we're going to be able to get a little bit of market action off of is at 10 a.m. we're going to get the existing home sales figures here in the U.S. Now, existing home sales are going to be an important figure today, because right now I think, unemployment is the major issue driving the economy. That's what everybody's focused on. That's something that affects everybody, especially if you are one of the unemployed. All right, but the housing market really is the major problem going on here in the U.S. because, you've got prices declining. We had such a housing bubble. People have been foreclosing on their homes. Banks are sitting there. They've got all these mortgages on the books. All right, interest rates have stayed extraordinarily low and prices are still going down. Well, what happens if interest rates start going up? That's going to put further pressure on home prices to go down. So, that's going to be a situation that the Fed is actively trying to manage because they don't want to see their buddies at the banks sitting on bad mortgages. How are they going to pay themselves bonuses? All right, they can't pay themselves bonuses. They could potentially lose more money, which means the Fed needs to come in and bail them out again. These banks haven't done much in order to get their books in order as far as, some of these mortgage problems they have, and the government has done absolutely nothing about trying to, solve this housing problem. So, that's the big issue right now, and that's one of the reasons why, you're seeing this crazy accommodative monetary policy here in the U.S. So, anyway, we're going to keep an eye on that. Looks like we're getting another little reversal candle here, which I'm going to hold off on this for right now because I want to wait and see what happens here right around the 9:30 open. But it looks like it actually held here a little bit. We got just pushed down a little bit more, but we're going to hold off on this. Let's take a look at some other pairs, see what's happening. This chart, this is pound dollar. Looks very similar to euro dollar. Let's see, Aussie dollar, same deal. All right, it looks like we're all pulling back towards that support area, which was the recent swing lows of the morning. Now, I'm just going to pop onto the 30-minute chart here. See, looks like 106.30 is a little bit of minor short-term support. All right, we could draw a little trend line here. Oops, that's GAN. I don't want that. Let me draw a trend line here, and we could sort of see that the short-term trend, we're just breaking that down this morning. Let me do that. All right, so this could be, a situation where we're going to maybe see the sell-off happen. Now, this could coincide with stock market opening, say 9:30, in about 15 minutes or so, 18 minutes. Okay, or it could also sit around and we can do a little bit of sideways action until we get that U.S. Existing home sales figures, which if those come in worse than expected, all right, then it's going to be interesting to see how the market reacts, because the market could say, well, wait a second, home sales are bad. All right, so that means we're going to get further QE2, further easing, so let's buy everything, okay, sell dollars. Or it could say, wow, things really don't look so hot here, okay, we want to, hit the flight to safety trade and buy dollars. So it's going to be an interesting dynamic to see what happens here. But at this point, we're still hanging on, and we're still looking for what we're calling these low-risk trades. Now, one of the other things that, you need to consider when you're talking about low-risk trades is that, it's really a bit of an art to have the patience to be able to sit back and wait for price to come into a level where you're comfortable with the amount of pips you want to take. All right, generally speaking, for intraday trading, I like to try and keep my stops to under 25 pips. I think there's a big move where a potential reversal or a potential trend change could potentially retrace most of the move. All right, or other times I want to keep the stops even smaller, under 15 pips, for intraday moves and for quick little spikes that can potentially happen. Now, when you think about where the trends are and what the trends are, especially when we look at something short-term like this, you can sort of see that, on this 5-minute chart here, all right, 2-hour short-term trend higher, boom, now we're in the start of a downtrend for the most recent 2-hour segment. Okay, so you can look at it from a perspective of what's the very short-term trend. And, when I see something like a very short-term trend like that, that's going to encourage me to do some intraday trading on that. So I'm on the 5-minute chart, and I'm looking for shorter-term and smaller stop losses. All right, but some might say, well, wait a second, that's a little bit counter-trend. Well, yeah, it can be. I mean, generally speaking, when people say, don't fight the trend, or the trend is your friend, or always trade in the direction of the trend, by and large, that is true, and that's good policy, all right, especially if you're a longer-term trader, All right, because if something just keeps going up on a daily basis, you don't necessarily care about the intraday movement and sort of the noise that takes place. All right, if the overall trend is up, then you probably should be buying. Okay, you should be looking for pullbacks. All right, to trend support lines where you can potentially buy it. Okay, which is going to give you a little bit lower risk. Now, longer term trades. All right, things that I want to hold. Now, for me, longer term trading is more like swing trading. All right, so that's something with say a 1 week horizon, which at the end of that time, I'll decide if the trade's really gone in my favor, and if I've perhaps found a change in trend or something like that where I think it could go longer, I would stay in it. But by and large, I don't plan my trades for that long of a time frame. So when I think about some of these shorter term trades, well, not shorter term, but the longer term from the swing perspective. All right, I'm looking for trades that hopefully I can get into with just about 100 pips, say, of risk. All right, so for me, 100 pips of risk is a decent amount, and give or take some. It's never going to be perfect. Well, a lot of questions I get asked from time to time is, well, how do you get yourself to a place where you're within that 100 pips risk you're looking for? And a lot of times the answer is going to be scaling into a position, especially longer term, because we know that this market trades 24 hours, and we also know that, not all of us have the ability to sit in front of the computer for 24 hours. In fact, I would say the majority of us don't. But one of the things you can do is you can place trades out there and put out limit orders. All right, if you're looking to sell ahead of resistance or buy ahead of support, you could potentially take, one portion of the position. Say, if your max position is, say, 3 mini lots, you could take 1 mini lot at the current time. All right, you identify where support is. You can buy another one if it goes a little bit lower. Buy another one if it goes a little bit lower. All right, now everyone's going to say, well, wait a second. Isn't that doubling down? You don't want to double down on losing trades, right? I mean, that's taboo. Never do that. Well, that's one of the things that we need to clarify and define. What is a losing trade? Well, a losing trade isn't necessarily a trade that you get into that shows a negative pip result and meaning that you're down money. All right, a losing trade occurs when your stop loss gets triggered. That's a losing trade. And if you're somebody who can come in, predefine your risk, okay, place your stops, and then honor them, all right, losing trade only happens when you get kicked out of the trade at your stop loss. Okay, because it's very rare that we get into a trade and all of a sudden it just, boom, moves up right in our favor, jumps ahead, and, hey, we're winning right out of the gate. Okay, well, yes, that is a winning trade. All right, a trade that is underwater for a little period of time, all right, isn't necessarily a loser until that time that gets stopped out. So let's see, some questions here. What time frame do I look for intraday trading? Generally speaking, I'm on the 5-minute chart, although some of you who've seen my webinars before know I also use sometimes a little bit of a scalping technique here, and I'm just going to show it for you. It's the 3 Bollinger Band setup I use. I use a 1, a 2, and a 3 standard deviation Bollinger Band setting. Okay, and the idea is that sometimes we're going to scalp in between each of these band levels. All right, what I'm looking at here on this chart, it's also a Heikin-Ashi chart, so you just need to be careful that you don't confuse this with a candlestick chart, because Heikin-Ashi is very much different. And what we're looking for on Heikin-Ashi charts is actually dojis to show us these little short-term reversals that happen. But I'm not actually going to do any scalping today. I prefer not to, but we'll see what happens. All right, but what I want to do is I want to come out and try and identify some support and resistance areas where we can think about potentially getting into some trades. Now, one of the things that is always interesting, and it's something that just seems so simple, but we talk about the law of round numbers in trading. All right, it's just so easy, but sometimes people tend to overcomplicate it. All right, we're just looking here at pound dollar on the 5-minute chart. All right, but if you look at these round numbers, 162. Let me see, let me get this back up. What the heck is happening here? Oh, here it is. Sorry about that. 162, 160, 150. Whoops. Can I get the line back, please? Here we go. 160, 150. Okay. And then lastly, let's just push it down to Oops, I want to go the other way. 161. All right, so you can see these three levels here. And as you can see, there are various times when they've acted as support, acted as resistance. All right, 161.5. All right, a little bit of support here, broke down through. We pulled back to just about 161.25. All right, ahead of that 161, came back up, held 161.50, moved up, tested 162, couldn't hold 162, pulled back just about to 161.50. Okay, so these are all, different levels that you can see that, technically speaking, mean very little as far as, what it means to the charts. All right, but when you think about just these different levels, okay, oh, looky there. There goes our euro play, moving higher right now. We're still in this little bit of a downtrend here, though. I won't, maybe going to hang on here and wait and see exactly what happens. But perhaps 142, well, let's say 142.15 may be some support there. You know what? I just want to look at this this Heikin-Ashi deal here and see what's happening. All right, this looks like we could get it up to 142.40 here very shortly. Okay, which would put us right at this middle Bollinger Band, which that's a pretty decent area. One of the things that you have to be concerned about is that when you place in these trades, sometimes with low risk trades you're going to get in, you're going to get out more often, but you need to be prepared to be able to get back into them if it presents itself. Now, I'm not loving this candle action here, nor am I thinking that 142.25 is that great of a support area for euro. So I'm not going to be inclined to take it just yet. And of course, this will probably be the time where, boom, the thing takes off and runs. But I'm actually going to be looking at some other little areas and perhaps some other charts that we could maybe take a look at. Now, what I want to do is I'm going to pop up Aussie dollar here, just with this setup, and let's just see what's happening with Aussie. Okay, it looks like on the 5-minute chart we've got Aussie just setting up just ahead of this 136.30 area. All right, what I'm going to do is I'm going to go in, I'm going to pop in here, and I'm going to buy some Aussie. Why not, right? Okay. Bought Aussie dollar. Man, look at that fell. That's a pretty bad one. Let's see here. So I want to stop myself just about 106.25. Let's do that. Oh, how much is the stop going to be? So the stop's going to be about, yeah, we can leave it right there. All right, about 18 pips. That's going to be about $36 loss if we get taken out on that stop. All right, so we're in on Aussie dollar right now, and this is going to be a situation where, again, low risk, $18 thereabouts, and hopefully we've caught this little trend bounce at the right time. Now let's see here. I just want to get some questions here. Let's see here. Questions about the Heikin-Ashi. Let's see here. Would I use the Heikin-Ashi on a 5-minute chart looking for doji? I typically don't use Heikin-Ashi on the 5-minute chart. I prefer to use candlesticks because, generally speaking, I'm going to try and scalp off of that 1-minute chart, and I'm going to try and do some intraday trading on the 5-minute chart. So that means that I want to give myself a little bit more room to breathe on some of these 5-minute trades, and I think that the candles give me a better opportunity to see those moves. Someone's asking if I can spell Heikin-Ashi. Yeah, let's do the Google. Thank you, Harley, for spelling that. Let's see. All right, so Dan's still in his Euro USD trade because he's got stops that are further away. Yeah, Dan, that's going to happen. I mean, here's the deal: is that there's going to be times when you get into a trade and you say to yourself, all right, this is where I've entered. I want to try and stay in the trade, but where can I place a stop? And depending upon what your entry criteria was for the trade, that's going to help determine it. Now, I had seen that you had gotten long Euro USD. Let's just go back to that for your trade here. You gotten into Euro USD about 15 minutes before I did on that initial candle. All right, so it looked like maybe you were playing off the 142.40 support area. All right, now I'm not sure where your stop is. Perhaps it's down even lower, down at, say, the 142 area, which that would be a pretty good place for support. But, as you can see, that's a decent size risk. And typically speaking, we're looking for about a 2-to-1 risk to reward ratio, at least 1.5 to 1 maybe, on intraday trading. So with a 40 pip stop or something above 25 pips, you're looking for about 40, 50 pips to the upside, which is possible. We could retest those highs at 143 and perhaps go higher, okay? But one of the things you just want to concern yourself about is that you just don't want to place bigger stops just for the sake of having bigger stops so you can stay in the trade. Obviously, you're taking on more risk, all right? If there's a time when maybe you want to get stopped out sooner, all right, and then potentially re-enter that trade on a better entry signal. But again, it comes down to what actually made you buy that to begin with. So that's what, that's what you just need to consider when you're placing some of these trades. Okay, so let's see here. Heineken-Ashy. All right. Well, you guys are, well, I guess it's midday in Europe, so it's all right to talk about beer over there, I guess. Let's see here. Question about, oh, there we go. Oh, Dan, you're in at 142, 113. Oh, you've been in this for a while now, yes? Okay. Oh, wow. You've been in this since about 3 hours ago. So it looks like you rode this higher, and then I'm not sure what your stop's at 142.13. Okay, I see. Okay, that's not bad. I like that. All right. So last question: what's the longest time frame I look at for a trend in short-term trade scalp? Generally speaking, I'm looking at the 2 hour, the 30-minute, and the 5-minute. Those are generally the top three that I look at when I'm looking at these trades. Generally speaking, depending upon exactly what's happening, let me go back to Aussie here. Let's see. That's not what I wanted, Aussie. Okay, so we're getting a little bit of a pop here. We'll see what happens with Aussie. It looks like Euro was the better pair to trade, but I missed that entry back down here around 42.25. But let's see what happens as we hit that middle band. Generally speaking, 5-minute, half hour, 2 hours, what I'm looking at for intraday trading. All right, and again, I'm just trying to find those low risk opportunities where I can place trades that are just going to be, low pip amount of risk. All right, not a lot, because I'm looking for at least 1.5, 2-to-1 risk to reward. Okay, which I know that if I can get into those and I can hit them fairly consistently, that I'm going to have profit. So let's see what's happening with Aussie here. We're back on Euro. Aussie's still flat, so not moving yet. I'm going to move this Aussie trade right to the 5-minute. Now, I got to tell you, on this 30-minute chart, I like this candle that's setting up. All right, and we got the support with us at 106.25, so that looks okay. Well, just come back and we'll look at Aussie on, let's do it on this chart because we're not playing with pound today. So we're about to open up here. We've got U.S. market's about to open shortly. Okay, we've got stocks indices that they look higher to start the day. All right, that's going to bode well for risk appetite in the market, dollar weakness, which hopefully is going to drive our Aussie trade here, which it looks like it just has. Okay, and also push the euro a little bit higher. So how far this is going to go, we're going to have to wait and see. But I'll talk about managing the trade as well. Let's see, Dan wants to look at Euro JPY, I assume, not JPEG. Let's look here, Euro JPY. Ready. Okay, Euro JPY, I can see that we're coming up here right around 117. Looks like there's nice support down here, say 116.60. It looks like we're probably going to break higher on this one. Now, I'm sure you all heard the news about Japan overnight, that officially now they are in recession. Okay, they had their second quarter of negative growth, came in worse than expected. I think it was a negative, it pushed the year-over-year number to down 3.7%, and it was supposed to be about half of that prior to. But we all know about the earthquake, tsunami, nuclear crisis that's going on there. It's no surprise that there is weakness in the Japanese economy. And quite frankly, it's the kind of thing where, for Japan, it's sort of like a been there, done that situation. Okay, they've had slow growth. They've had this lost decade for the last 20 years, so it's really more than a decade, but who's counting? So, they're used to dealing with these things. And, they had there's a nice little pop on Euro JPY right through 117. Hope you caught that one, Dan. Let's see here. Let's go back to, we got, it just came up here on the touch of the middle band here on Aussie. So let's see what happens here. Maybe we'll get a retest of that and then a push higher. If we can sit up on the other side of the 20-period moving average, I'll feel a little bit more comfortable with this trade. But getting back to Japan, so they've got the rate policy decision coming out tonight, and there's some expectation in the market that Bank of Japan's going to do some further easing to try and help with the situation. All right, but what they're going to experience is they're actually going to see a little bit of growth going forward from the rebuilding efforts that are going to take place to sort of fix what's happened as a result of the tsunami and the earthquake and the crisis. So, while near-term things don't look good in Japan, all right, the longer-term outlook could be pretty good. So, we'll see what happens. But I think, yen strength and the safe haven play that's been going on for a while, that needs to reverse a little bit. And, what it's going to take to do that, though, I'm not really 100% sure what that's going to be. So, all right, so we've got U.S. stocks opening. Okay, looks like we're opening a little bit higher. A little bit of risk-taking going on. Just look at Aussie. Look at Euro. Okay, Euro coming back through 20-period moving average. All right, we got the Aussie flirting with it as well. So it looks like the kind of day where, the better than expected initial jobless claims figures, all right, people were happy with those because it wasn't 420, it was 409, and while that's better than expected, still not good, but, that's okay. What's going to happen, though, at 10 o'clock is going to be a different story, but the existing home sales coming out. Okay, because again, I think that, people are really concerned about the housing market. Nobody's really saying it, but, when you consider, what happens with interest rates, with housing prices, that's really what's been holding back the Fed right now, is that they're afraid that, if they raise rates, home prices are going to fall further, there's going to be more foreclosures, banks are going to be sitting on bad mortgages, which means that they're going to have big losses, which means that the Fed's going to have to bail them out, which, it's going to set off, basically another, cycle down. So, what they do about it, anyone's guess at this point, but, frankly, my opinion is always, just get it done, take the pain quickly, take your medicine, and, move on. It's kind of like, when you pull a Band-Aid off, you just want to sort of rip it off rather than, just kind of piecing it and yanking it little by little as the hairs on your arms start yanking out. You're better off just, boom, one shot, pull it off and get it done with. So, let's see here. Boykie's saying they'll give you money when you take out a mortgage. Yeah, it's possible. I gotta tell you, the banks right now aren't lending though, here in the U.S., Dan, because of a lot of reasons, but I think one of them has to do with this Fed policy. If you think about what banks are typically were set up to do, and this is, before the advent of these banks turning themselves into casinos, into mini hedge funds, into gambling in the markets with these huge trading desks and making profits that way. The way a bank used to make money, okay, was because they would borrow money from the Fed at a certain amount of interest, right, and then they would turn around and lend it out to a potential home buyer or a consumer. All right, and they'd charge a markup on that interest, and that difference they made was how the bank made money. Well, if you think about it, the bank's borrowing from the Fed now at no interest rate, right, so it doesn't cost them anything, so they don't have to lend that money out. All right, and I think that's one of the negative consequences that we've seen of this Fed policy here in the U.S. Let's see here. Question, do I ever have the need to watch the dollar index? I typically don't watch the dollar index, Harley, just because it's a future here in the U.S., which means that requires an additional data feed, which you got to pay CMA exchange fees and or just set up for free demos all over the place if you don't want to pay those. And frankly, I can look at these dollar-related pairs and get a pretty good idea of what the dollar's doing just by looking at Euro USD, Aussie USD, and the like. So let's see, next question from Boyke. How can Japan have interest rates less than zero? Well, it's interesting, but you talk about quantitative easing and monetary easing. That's essentially how countries can maintain interest rates that are less than zero. All right, if we actually took a look at what real interest rates are in the U.S. because of this quantitative easing, I would bet that they're below zero as well. All right, you're talking about just Fed and Bank of Japan massive buying of these bonds, not allowing interest rates to rise. So that's sort of how it happens. Harley's saying soon FXCM is going to have them. You know what? I heard something about that. I'm not sure exactly what FXCM is doing. For those of you unaware, I work for FXEDU, which is, we're an IB that does Forex education, but we are, we work with FXCM. All right, that's our who we refer to. So, I really should be a little bit more in tune with what they're doing at FXCM, but frankly, I'm not one of the FXCM inside guys. But it'll be interesting to see what they come up with there at FXCM. So, all right, so this looks pretty good here. This Aussie USD trade. What do we got? We're only 5 pips up. Man, it seems like so much more, right? I think it was from our initial bogus entry here. But we're moving up. We're coming back down to take out some of those earlier losses that we saw, and perhaps Euro would have been the better trade, just ahead of 141 or 142 rather down there. So, how do I assess which entry may be a low-risk entry? That is a good question, Jack. One of the things that I look at, it goes like this. All right, basically, I'm a price action trader, so what I'm typically looking at is support and resistance. That's the first thing. All right, but there are other little triggers that come in that give me an idea of perhaps what the probability is of a of a trade working out, say, more so than another. And some of the things I look for, all right, especially at areas of support and resistance, are what type of candles are setting up. Are these candles that look like reversal candles, or are they candles that don't tell me much? I'm looking at the Bollinger Bands. Do we get a violation of the bands? All right, are the bands starting to roll over and flatten out a little bit? Are they starting to narrow? I'm looking at my stochastic. Is it oversold or is it overbought? Okay, I don't use the stochastic for the entry criteria, but it's nice to look at just to give myself an extra confirmation. All right, if I see a trade that looks great on the buy side, but I see that it's still overbought, not oversold, that may give me a little bit of hesitation. I may say, well, you know what, this doesn't look as great as, say, the other trades. But, that doesn't necessarily mean I won't take it. It just means I'm going to keep that low risk in mind. So, just that short amount of risk. That's really what I'm trying to do, is just maintain a smaller amount, pip amounts, okay? Because I know that I can always jump back into the trade, okay, if I get stopped out, but if the market doesn't give me a reason to get back in, then I can step aside. Now, we probably should have hopped back into the Euro here. I was sort of, flitting around and wasn't paying much attention. And, a lot of times, when I try and get into these trades from a low risk perspective, if the trades move too far, all right, I won't take it. Unless I decide, okay, well, I do want to take it, but I'm willing to take on a little bit more risk. But for the purposes of this webinar, we're talking about low risk. So, I don't want to always take on more risk, but sometimes, if I get into it, if I miss the entry point, perhaps I'll scale into the position, or maybe I'll buy some at current market and it pulls back a little bit closer down to my stop. Maybe I'll buy a little bit more. So, that's a way that we can look at it. And, hopefully in the, second half of this, webinar, all right, the early session, here on low risk trading, we're going to look at some longer term stuff and see if there's a way that, we can see some trades that we could potentially do from a longer term perspective that can help us lower the risk. All right, so we've got, looks like Euro's pulling back here, so I'm guessing Aussie's pulling back, sure. But let's see if we can sit up here just above this, middle Bollinger Band here. Okay, because I'd like to, okay, boom, that's just a nice little push down there. So let's see what happens with this candle. If we close below here, all right, this may be an area where support is not going to hold, and we may be back to the downside. So just going to keep an eye on this and see what's happening here. But I'd like to see the bar close above this 20-period moving average right here to give me hope that we're still to the upside. All right, so do we have any other questions about what's going on here this morning? Again, the low risk idea is it's not, listen, there's always risk in the marketplace. And as traders, one of the things that people have the hardest time with is accepting risk. Nobody likes to lose on trades. And, my opinion is the opposite, is that I prefer to lose on trades very little amounts, than to see myself get into trades where I've got a little gain, I've got a little gain, I've got a little gain, and then wham, all of a sudden I've got a big loss that just wipes out all those gains and takes me out. Okay, I'd prefer just to rack up little losses all day, because I know at some point, all right, I'm going to find that trade that's going to be the profitable one, and hopefully I'm going to catch it and be there to get in. So, for example, all right, here we are. We're now negative on this trade, just by a little bit. All right, and it was up a little bit higher, 5-6 pips. For me, it doesn't make sense to take that off and then to re-enter. I mean, that's going to put me back in the scalping situation. All right, so I prefer to see if the support's going to hold here. All right, maybe we're going to come down and test the support going into this existing home sales figures. I mean, I think a lot of people now are, starting to catch on to what's been happening here, with the Fed and monetary policy, why they're doing what they're doing. Why it's okay to have $100 oil and to send people who can barely afford it, with unemployment rates up above 9%. Why it's okay for them to pay, $5 a gallon for gasoline, all right, but it's not okay for a bank to take a little bit of a haircut on a potentially falling mortgage. So, the housing issue is going to be the big issue, and I mean, that's just something you don't even hear government talking about. Now, the Fed, they can't solve the housing issue. They can't come up with rules or laws or a way to try and unwind these things. That's got to be done, through government. And I mean, these guys right now are just so lost that they don't even know where to begin. So, that's kind of what we've been seeing so far with Fed policy. So, our trade's sitting in here right now. Would I like it to be up above this middle band? Yeah, of course I would. But we're going to see, how this thing happens. All right, so let's look at euro, take a quick peek. So euro's still hanging in there, which tells me that the dollar's still a little bit weak. All right, but we're just under that 142.50 area. All right, I'm looking here at the 30-minute now on Aussie. All right, you can see that we just sort of touched that trend line, which, previously had been acting as support. All right, maybe now it's going to act as resistance. What I'd like to see is this thing get up above 106.50 and hang on there, and then perhaps we're going to retest what looks like a 30-minute double top here at 106.75. So we're going to keep an eye on this, but again, it just requires patience sometimes, especially when we talk about low risk. Did I just say haircut? What do I mean? Basically, haircut, I was just talking about, them taking a little bit of trimming their losses, sort of what the idea was there with the haircut. I apologize for that. That's, that's some of the stuff that we talk about. All right, let's see here. My point of view on the case, I have an EU short with 143. Okay, you know what? I like the here's what it comes down to, and this is, also part of what it means to, be trading, is that if I had a short like you did ahead of 143, I'd be probably inclined to stick with it, all right? Maybe I would have taken some off a little bit lower, okay, when we hit that first area or that area of support where we got the bounce in the euro, all right? But when you have a good entry point, say up around that 143 place, all right, that's not a bad time to stay short, because, at the end of the day, it's very difficult to say, okay, this is exactly what's going to happen. If we all had crystal balls and we were all forecasters, okay, we wouldn't be on these webinars, right? Everybody would know what they were doing. Everybody would be making a ton of money, all right? But what it comes down to is it's taking a position where you can get that low risk entry, all right? So if I were short ahead of 143, I'd feel pretty good right now, all right? But I'd just feel better if I took a little bit off, maybe at 142.25, all right? And maybe I would use a stop to try and lock in some of my gains. All right, it's you hate to see decent gains, say close to 50, 65 pips, kind of vanish just because you're sitting in the thing. But right now I can see that these bands are starting to narrow, so perhaps 142.65 is going to be a little bit of an area of resistance. Okay, and we've got about 15 minutes till this existing home sales figures comes up, so let's kind of wait and see what happens. Let's see. Question from, would I go long dollar CAD in the long term or wait? Well, let's take a look at dollar CAD and let's see what we're looking at here. All right, dollar CAD 5-minute. Wow, look at that nice reversal candle there, just ahead of 96.50. Let's see. Let's look back. I'm going to look at the 30-minute chart. All right, let's see, we're back up to 36.75 area. 36.50 is, 96.50 is probably going to be a pretty good area for support down there. Let's look at this on the 2-hour and see what we've got. All right, well, on the 2 hour, it's not telling us a whole heck of a lot, okay? But if I think about this, you can see 96.25, and then lastly, 96 is some support. So if you did want to get long this from a longer term perspective, okay, maybe you'd want to take like a little piece here, say 96.75, all right, and then maybe you'd be willing to add some at 96.25, all right, with your stop just below that 96 area, all right, if you think that dollar is going to move. So that's what I would look to do here with dollar CAD, okay? Just want to go back here and see what's happening with this euro. All right, looks like we're setting up just ahead of 142.50 right here. Let's see what Aussie's doing. Okay, Aussie's making a little climb back, so we'll see. All right, so this is kind of what, I'm doing on a day-to-day perspective, okay? It's not about, figuring out where price is going per se, all right, but it's about managing that risk to the downside and finding these lower risk opportunities where, if you get in and you happen to be right, hey, that's going to be a decent trade for you, okay? I mean, a lot of people, when they trade, they say, well, it looks like it's going up, so I want to buy it. Well, that's a problem sometimes because, that a lot of times you'll end up buying the top. People say, well, it's in a trend, so just buy it. Well, you know what? I prefer to get a better entry point. That's just how I like to trade because I know that if I'm lost, I'm going to cut my loss quickly, all right? And if I'm right, it's going to move, and I'm going to be able to let that trade run. And that's really what you want to be doing. It's letting your winners run, cutting your losers short. And it doesn't matter if it's within the trend, counter trend, trend reversal, whatever the case may be. All right? The idea is that if you can keep your losses low, okay, you're going to be around to trade another day, as they say. If you have a big loss that occurs and that takes you out, guess what? Game over. You're done. All right? But a little loss you can sustain. All right, a little loss you can define ahead of time, and you know, hey, you know what? I've risked $25 on this. That's my lunch. Okay, maybe I don't eat today. And that's the kind of way that I look at these things because if we're right about this Aussie trade, I could see us going back and retesting the high here, 106.70. I could see us getting back up potentially to 107. All right. But we'll have to see what happens. Now, the idea of the fundamental story and this initial jobless claims coming up, or I'm sorry, not the initial jobless claims, but the home sales, I'm not feeling 100% confident about that because, I think that the number is going to be worse than expected. But, you know what? I've got my risk managed there. I'm sitting in there, and I'm going to let the market expectation tell me what happens. All right, if the number comes out and it is bad and it looks like it's going to be a risk aversion type of day, maybe I'll get out and just take the profits or jam out of the trade wherever it may be. All right, but if a lot of times you can be right about what the news is going to be, but be wrong about what the market expectation is going to be. Okay, and when you think about these Fed minutes from yesterday, they're not in a hurry to end QE2 anytime soon. So existing home sales, if they're better than expected, maybe that means that they'd be more inclined to end it early because that big problem that they're concerned about, that they're not talking about, the housing market, could be improved. So that's one way to look at it. All right, let's see here. Question, do I avoid trading around news times because of the uncertainty whether I'm right and wrong in the news forecast? Yes, sometimes I do. A lot of times what will happen is if I don't have a position already in play, then I'll wait for that news release to come out and then decide what I want to do as far as whether I want to get into the trade. A lot of times if the news is going to be, big news that's market moving, something like non-farm payrolls, all right, I'll wait for that news to hit the tape, wait for prices to go flying in one direction. And a lot of times if it comes up to near support or resistance, I'll try and fade that initial move. All right, because one of two things are going to happen. First, you get that initial, whammo move, which is huge, which is very hard to catch. And you don't want to be in that situation where, you're jumping on it only to watch it, fly high and then fall back down. What I usually try and do is I usually try and fade those moves. All right, but then after that, you have to ask yourself, well, hey, what kind of a pullback do I get from that initial move? If it's strong, perhaps the initial move was wrong and you can be in it. You've got a nice entry. But if you are incorrect and it looks like that initial move was right, you want to jam out quick, take it for a quick scalp and get out. So, all right, so this is looking better here on this Aussie deal, and we're about 10 minutes away from the U.S. home sales figure. So we're going to see what happens. You know what? I mean, this could be the kind of thing where, I think this is going to be big market moving news. Maybe it's a non-issue. Maybe it's a non-event. Maybe, it doesn't do anything to the market. Let's see here. What's the typical per day? Well, my typical per day is positive pips. It just depends on how many different pairs I'm trading. Generally speaking, about 50 pips a day is what I look for. Let's see here. Some other questions. Let's see. Do I think using fibs with the Bollinger Bands helps or complicates for the 5-minute chart? It's hard to say, Ramy. That's a decent question. And, sometimes when you get readily identifiable trends on the 5-minute chart, the Fibonacci can help you. But generally speaking, intraday moves, I actually prefer to use pivot points to see some of these different levels that are out there. I think for the intraday stuff, it works out a little bit better. And I prefer to use Fibonacci on the longer term charts because, it seems like, with the longer term stuff that, it tends to be a little bit more valid and hold up. So, alright, so, Aussie's looking good here. We've settled firmly above this. My expectation is that we're gonna hit at least the top of this Bollinger Band, which, gosh, we're still even negative on the day. Look at that. Let's see here. Let's see what Euro's doing. I bet you Euro's flying high. Yeah, of course, Euro's moving higher. That was the trade we should have been in. Alright, we got 50 pips on the Euro, and the Aussie's only gone for us, about, 10. Wonderful. I hate when that happens. Question, could somebody, be a pro trader if he or she consistently earns 50 pips a day? Well, sure. Why not? It all depends on what you're defining as pro, meaning anybody can call themselves a pro if they do this full time. Can you make a living at it? Can you support your family? Can you take care of your bills? Can you save for the things you want in life? That's another question. 50 pips a day is great for somebody who's got a $10 million account and can fire around, some size. But if you're a guy who's got a micro account with $100 on it, 50 pips a day probably isn't going to help you. But the idea is that you always want to shoot for positive pip accumulation, okay? Because if you can get into trades that are going to be consistently winning, okay, the more confident you get, you can always increase the size you trade, all right? If you don't have a lot of money to get started with, that's all right. Just trade small. Don't, shoot for the stars right away and just build your confidence. Eventually you'll see that account's going to start to build up a little bit. As you start to get some money into that account, then you can increase your size a little bit, and then you're going to see bigger gains on that pips. If you just keep doing that consistent level, all right, eventually you're going to get there. But it's a journey, I mean, trading is a means, not an end. Everybody thinks, I'm just gonna make a ton of money and retire as a trader. Well, you know what? Trading this market probably work harder than just about anybody else you know. If you think about it, you're up at all hours, random times, all right, glued to that screen, paying attention. I mean, it's not like, we're running out for a coffee break here in the next 5 minutes because, we're waiting on this, existing home sales figures. I guess, this, LinkedIn is coming out here too, on an IPO. I wonder, if they're gonna coincidentally time the release of that with this, existing home sales figures just to sort of, brush that under the rug. But, we'll see what's happening. Can we look at Euro Pound? Sure. Where do I want to look at this? Let's go right here. Euro Pound. Alright, Euro Pound breaking out to the upside. Looks like it's got a little bit of resistance up here at 88 and a quarter. Let's see what's happening. Oh boy, yeah, I like this to the long side. You can see right here, just tested 88. Once it got back above there, looks like that held. Euro Pound, it's, pure fundamental play, basically Eurozone versus, UK. So it sort of sometimes removes some of the risk themes from the market that we talk about, which, the moves typically aren't as big as, say, euro dollar. or potentially Aussie dollar, which unfortunately still isn't moving that great for us, although, yay, we're back to positive for the day. I like when that happens. Although as soon as I say that, we'll probably go negative. But, you can see how, you can trade this with different moves, different size. Now, at the end of the day, this webinar is just for demonstration purposes, so I don't put on a lot of big size to try and give everybody that, rah, rah, look at all the money we're going to be making type of mentality. Trading is it's a serious endeavor, it's a business, and the more realistic you can be with yourself, the better off it's going to be. Let's see here. Question, is your favorite pair to trade? Sometimes. It depends, really. Sometimes I like to trade cable. Sometimes it's pound yen, Aussie dollar. It's another one I trade. It really just depends. And a lot of times what it depends on is what's driving the market, all right, where I can get my entry points. For example, we could have jumped back in the euro when we were looking at it. I'm just going to pull off euro pound here for a second. All right, but when we saw the euro coming back, all right, I would have preferred to have bought it a little bit lower. So by the time we were looking at it, it was back to like 142.36, which was where we initially had gotten into it. And I didn't like the entry point as much there because now I needed to have much more risk on it, okay, which would have been about 28 pips of risk. So I decided, well, I don't want to take the euro here. But looking at the Aussie, all right, we determined, hey, that was a better place to get into it because the risk was going to be a lot smaller on that. Okay, so we got Aussie moving here. Yay, we're up some. Got about 17 pips on this one, which is pretty good. Now, I could be inclined to move my stop up higher here to break even, something like that. We've got this new home sales coming out real shortly. So maybe this will be a time when I would move my stop up to break even and just say, you know what, if this thing is going to go, I want it going in my favor, and if not, I just want to be out. But I think what I'd prefer to do is actually just sort of trade this live and see what's happening, because I see, as we're getting up here to this 106.60 area, we had a little bit of prior resistance here earlier in the day. You can see how these candles are setting up with these long wicks here. All right, we've got what looks to be like a shooting star happening, and we're just starting to approach this overbought area. So I'm going to keep an eye on this. We're only up, whatever it is, $6 here. I'd like to see this thing move a little bit higher. And if we go back to the 30-minute chart, let's just see where we are in the 30-minute chart. All right, I think we could retest this 106.80 area. Okay, but right now it's not, it's not that much further from where we are right now. So maybe I'm thinking about potentially getting out of this and actually doing a little bit of a reverse here. That's also something we could consider doing. Okay, I'm just sort of want to stick with it just a little bit and see, but maybe I will move my stop up to break even. Right here, let's do that. I'm going to cancel this stop. What do I want to do? You know what? I'm going to change the stop, and let's just put it up to right there. All right, we're going to make $1.80 if this works out for us. All right, now we're just going to see, what happens with this news that comes out, and if we get, a number that on this existing home sales helps us out, then that's going to be a decent spot potentially, and we're going to be all right to continue higher with this trade. But if it's worse than expected, it's going to pull back, we'll get stopped out, and then we can reevaluate. I mean, I could take the trade off right here, but, again, we're only up, we're up 14 pips, which isn't horrible, but, our initial stop was about 18 pips, or 15 pips rather, so we're about 1-to-1. I'd prefer to see a little bit more here, and maybe, we should have thought about taking it off around 160.60. Let's see, question. Do I watch CNBC during the trading day? Yeah, I go back and forth between CNBC and Bloomberg television, depending upon what's happening. Do I ever move the stop further away? When you say further away, as far as moving the stop up in the direction of the trade to lock in more gains, yeah, a lot of times I'll do that. But I usually like to give it a little bit more time to get there. But will I ever move the stop down lower than where I initially started from? No. No, I'll always take the stop and get stopped out of the position and, look to reevaluate and get back in. All right, so we're just going to be waiting on this figure here for a second. Just give me a quick sec here. I just want to grab a drink of water, and let's see what's happening here. Oh, I've got bad weather here. Actually, it looks like my television's frozen up here, so I can't see the announcement on the initial on the new home sales. So let's see. Do I need it? Seriously? No, I don't need it. But sometimes it's helpful, and that's just really what we're thinking about. So let's see here. All right, looks like Aussie's setting up, and this looks like a pretty decent reversal candle. Okay, and we sort of have this short-term resistance here at about 106.60. All right, let's see what happens here. And it looks like we're pushing down a little bit. This number came out, and I'm guessing that it's not very good. And we're out. Okay, well, we can see how that happened for us. That's a time when, again, we could have taken our trade-off up top there when we saw that reversal candle. But to be honest with you, I prefer to have it as a no trade or a risk-free trade because, when you think about it, it's the kind of thing where, the thing was up 6, 7 pips, 10 pips at one point. Sure, that would have been nice. And if we were going to go ahead and scalp the whole day and do that sort of thing, then that's a pretty good trade. But, I was looking for a much bigger return on what we were doing. All right, so by moving the stop up, all right, we're still, we got out of the position. Okay, we still could have been in it. All right, and now I can sit back and I can look to reevaluate this and say, all right, wait a second. You know what? Let's see if maybe this is the time we want to rebuy this. And right now it looks like the home sales were down 0.8%, which that is worse than expected, but that's actually not as bad as people were thinking. Let's see here what the estimates were. Let's see, the estimates are they're expecting a gain of 2%. Well, I don't know who was really expecting a gain of 2%. That may be the number that they've been trying to peddle to us, but I don't see that happening either. So actually, this is a little bit better, I would say, than what I had thought. And we can see here that Aussie's starting to move a little higher. Let's get a peek at what Euro's doing. Okay, looks like Euro pulled back just a little bit. All right, but I'm guessing that this is going to be okay for the market, that we're going to continue to see maybe another push higher here. So let's just kind of hang on and see what happens. Still a little bit of volatility happening. Okay. But this could be a time when we could potentially hop into this thing, all right, and maybe just stop ourselves just below there. So maybe we could get in with about 8 pips of risk. Okay. But let's just kind of give this a minute and see. Do I have dollar ZAR? I do, but I don't typically look at it from a day trading perspective. Spread's a little bit wide for my taste, so perhaps if it was a longer term trade, I'd be looking at it. Sometimes people like to use the South African rand as a proxy for the Brazilian real, so that's a time when I tend to look at it. But generally speaking, the South African economy in and of itself doesn't have a lot of juice on the international stage in my book, so I tend to stay away from it. So, all right, so we're just watching what's happening here. Oh, excuse me. And let's see. It looks like this thing is starting to move up a little bit higher. We're just about 106.50. All right, 106.44. That's the low of the area, but it looks like we're starting to just see a little bit of a stochastic roll over here. So let's sort of keep an eye on what's happening. And, the idea is that we're trying to be patient here. We're trying to be good. Let's see what's happening with Euro. Euro, okay, this looks like it wants to push higher. All right, now we're moving back up here on Aussie. All right, so let's see. Thinking about potentially getting back into this Aussie trade. But right now, it's I prefer to see it pull back a little bit more and wait and see. I mean, you can still sort of see how this candle, it's just a very long wick candle. Now we also had the Philly Fed Index that came out as well. So, let's see what that did for us as far as what the numbers were. Let me just refresh the screen right here. I'm on the daily FX calendar. This is usually pretty handy dandy. Let's see. Philly Fed didn't show us anything. Leading indicators were lower. Okay. Let's see. Someone's looking at resistance on Euro USD 1 hour chart. Oh, let's take a look at that. Euro USD 1 hour chart. Yeah, 143 has been resistance, but I could see this thing coming up over this and busting through there. All right, now we're back up near the highs on Aussie. Okay, perhaps on this little pullback that was a good buy for us, and maybe we should have considered that. Right now, I don't want to get into this and buy this here because I feel like we're going to be buying it sort of towards the top. Had we held our stop down here at the initial, we'd still be in this trade. Okay, but when you see the news happening, you can see that you get these, these sort of crazy candles. And sometimes it's just better to step aside and to, kind of let the news play out, especially if you're trying to come up with a thesis about what may be happening. All right, so it looks like the worse than expecting housing numbers has actually, increased the idea that maybe this quantitative easing too is going to be around for a bit. And as you can see here, Aussie's still up, but we're going to be approaching this resistance area right up here around 106.75. It's only about 10 pips away, and it looks like we're starting to hit a little bit of an oversold area. All right, I may actually potentially think about doing a short here at some point. So let's maybe see what happens with these candles, see how they set up, and then we'll see if there's going to be a trade in here for us from the short side. Let's see here. Somebody bought the Aussie at 106.50, and he bought it the second unit when it returned. Wow, LinkedIn opened at 88.7. That's interesting. I guess the IPO initial price was around 45. It's now at 88.7. It's like the old heydays of the IPOs of the tech stocks. All right, so I'm starting to see this candle setting up here, and we're just about 106.57. All right, I can see the 106.75 is a little bit of an area of resistance. All right, perhaps we should have sold it up just a little bit higher, but let's wait and see what happens. And actually, let's take a quick peek at the euro. Okay, someone saw the euro resistance up there, and we're getting close to 143. So maybe we want to hit the euro here. I don't know how that sounds to anybody, but let's take a look here because I see this thing is overbought and we're starting to come off a little bit. I'm actually going to sell euro here at 142.75. All right, we just hit the euro, and what I'm going to do is I'm going to put my stop up here just above 142.92. All right, and we're going to see if this thing can hold here for us. Stop 142.92. I'll say. Okay, so we're going to risk about $37. All right, which is going to put us down about $60 on the day. Generally speaking, trading about 2 lots. I want to try and keep the loss to under $75 a day. All right, because with 50 pips, I can do around 100 to 125 a day. So that's going to be right around in there. But as I look at this candle here happening on the euro, perhaps we jumped the gun just a little bit. Okay, and it doesn't look like this may be finished just yet. But I'm going to keep an eye on this 143 level. All right, that's going to be some obvious resistance up there, and we'll see what's happening. Harley, so basically I'm using the bands as support and resistance, classic Bollinger Band trading. Yeah, I do use the bands as support and resistance, but I also use price levels, swing highs, swing lows as well to try and figure it out. The bands just show me sometimes when we hit those oversold, overbought areas. And no, let's see, works well this morning. Well, I guess it works well for somebody else perhaps. We haven't taken the profit yet that we're looking for, so we're still down, or at least I'm still down. So, it can work. And it's like anything, anything can work. It's just a question of, what you're looking for out of the trade. Are you looking to do this shorter term, or is it perhaps a little bit longer term? And it all comes back to your perspective, what your risk tolerance is. The idea behind this webinar was that, I wanted to show people how you could potentially take these trades from a low-risk perspective, okay, how you don't have to take on excessive risk, how you can find places where you can get entry points and you can be profitable. And if we wanted to scalp today, we totally could have been profitable. I mean, we had trades that were up at certain points, and, boom, you can just jump in and jump out of these things all day long. So with the idea is that I'm trying to find an area where I can get into a trade that it's going to be fairly low risk, that potentially I'm going to be able to hit that trend reversal, that minor trend reversal within the day. All right, and then we're going to get a good entry and be able to move. So, for example, Euro here, all right, I kind of like this to the short side. We'll have to actually see how this plays out. If we can get a little bit of a push here, perhaps get a breakdown of, this area here at, say, 142, 68-ish, that sort of area, then perhaps, we'll see everybody running for the door. Okay, because the idea was, if we think about the thesis here, what happened with these existing home sales, all right, they came in worse than expected, all right, but maybe not as bad as people were thinking, okay, and, maybe the idea that, well, this further QE is going to be a good thing, maybe people are starting to change that sentiment and say, well, this is maybe a bad thing. All right, but we can see right here that, it looks like from the short-term perspective that Euro still wants to go higher, that dollar is still, a little bit weak today, but, this is like a classic battle, where we're just going to sit here and sort of wait and see, how this thing plays out. It's I don't really want to guess and say, okay, well, this one makes more sense than the other. But all I'm doing is looking at support and resistance areas, finding these low-risk opportunities, taking a position and getting in and not hoping I'm right, but, hoping that, that the sentiment follows through and that what I saw lining up on the charts as far as the support and resistance levels, somebody else is perhaps seeing and selling. So that's sort of what we're looking at here. Does anybody have any questions about any of the ways that we're doing this? Let's see here. Is my preference to use Bollinger Bands rather than the moving averages, or do I mix it up? Generally speaking, I like to use the bands over the moving averages. All right, the moving averages, it's the middle band, for example. That's a 20-period moving average. Okay, some people tell you, well, you get the 10, the 20, the 50, the 200, and depending upon how long your time frame is, those can be helpful. All right, but generally speaking, for my type of trading, the 50 and the 200 do nothing for me. Okay, because I have an idea of where the trend is anyway. So if we pulled up the 200 on the euro, then we'd see that the euro is wherever it is. Let's just pull it up right here, if you'd like to see. But it looks like the trend is down, so I'm guessing that it's probably below. But at the end of the day, for these shorter term intraday moves, it doesn't matter as much, generally speaking. So that's sort of what I think about moving averages. Why do I like the bands? Well, the bands are interesting. I mean, it's the kind of thing where if it ain't broke, don't fix it. And that's sort of how it's been throughout my trading career. I started off, bands was one of the first things that I learned. I actually worked with a guy way back in the day who was, one of the first guys really doing technical analysis, at some of these day trading shops. I started out as a stock trader back in the day, and most of the time what was going on is that you had a couple of different ways people were trading. They were trading something called tape reading, okay, where you were actually trying to read the specialist to figure out which way prices were going and try and take these short-term moves. Then you also had something called SOS bandits. Okay, SOS bandits were, people who tried to pick off the bids and offers of market makers and NASDAQ stocks. So those were, really what people were doing. But, I worked with a guy who, really started in technical analysis. Right? It was a little bit different from what most of these people were doing in these day shops. And, we'd sort of studied the bands for a while and figured out a lot of different nuances about the bands that really helped our trading. All right, for example, you can pull up a discussion of the Bollinger Bands on, any website, and it's going to tell you, the bands, you trade in between the bands, you sell at the top, you buy at the bottom, and, boom, that's it. Well, there's a lot more to it than that, and, some of the nuances that I've picked up have really been able to help me as far as things like the slope of the band, all right, when the band narrows, when the bands widen, where the band's occurring. All right, and I actually had a conversation with John Bollinger many years ago about it. I said, why don't you ever discuss the slope of the band? And he just sort of gave me this wry smile, and I said, okay, I knew I was sort of onto something. So anyway, as I'm yapping away here, what's the target on this euro trade? Target is right now is about 142.50 area. I'm hoping we get a retest down here. But let's wait and see what happens. It looks like it's putting in just a little bit of support. We're just sort of fighting it a little bit. Okay. Let's see what Aussie's doing. All right, Aussie's coming back, sort of retesting these lows. So my first target's going to be around 142.50. Okay, but we'll see what happens. I mean, I'm not, I don't preset my limits. Okay, I just preset my stops because I want to see what's going to happen at 142.50. All right, if we come crashing through 142.50 because that's an area of potential support, and the market just sort of, brushes it aside, that means that there's going to be some pretty heavy selling taking it down through there that quickly. All right, so that means that I potentially want to stick with the trade. So I'm just going to wait and see what happens with the euro here. Let's see, question. What's the difference between support and resistance, and can I determine from the chart and the pivot points? Thanks. Well, I'm not going to take a look at the pivot points here because that's an entirely different discussion. Unfortunately, we're going to be wrapping this up here in about 15 minutes, but perhaps in a future webinar I'll take a look at it. But as far as the support and resistance goes, I'm just looking at some of the short-term support and resistance from a perspective of swing highs and swing lows. Okay, and we can also drop back to this 30-minute chart. Okay, and you can sort of see where we've been trading in a range here in euro, say 143 to 142. One of the other things that I like to think about, especially when you're looking at some of the ranges that these things are in, is that as you get closer to the top of the range, I usually prefer to be short there. Okay, if I have to initiate a trade, I want to be short near the top of the range rather than long. All right, and the same thing at the bottom of the range. If we're near the bottom of the range, I prefer to be long than short. Now, that's not to say if I've already established the position that, I want to flip it around. Not necessarily. I want to wait and see what happens. Okay, but it's the kind of thing where, sometimes, you're going to get a breakout to the upside. Okay, well, if we get a breakout to the upside here, I don't want to buy this breakout. I'm actually going to wait for a pullback. And if I don't get a pullback, then that's going to stink for me because that's a trade that I'm not in. But so be it, okay, because that lines up with my risk to reward. If I were looking to buy this thing where we actually shorted it, all right, I'd have about 25 pips of risk going all the way back to 142.50, all right, but I think that there's much more resistance up at 143, all right, and when we talk about the longer-term trend, all right, we know that the longer-term trend on Euro USD is down, so perhaps that's an area at 143 where there's a lot more resistance than there is short support, or minor support, I should say, rather, at 142.50. Let's see here. What's the... Have you ever not traded for a day? Sure. Take time off all the time. I tell my wife vacations cost us twice as much because not only do I have to pay for the vacation, I got to pay for the time that I'm not spent trading and getting paid. So, yeah, there's always times when I don't trade. Let's see. What about the slope of the bands that I can share with you? Okay. Good question. A lot of times what you'll find with the bands is that, because these things are based on standard deviation, that you're going to see them expand and contract as you sort of go along. And, obviously when the bands expand, okay, you want to trade in the direction that price goes. But just because the bands expand and, maybe the initial expansion is to the upside doesn't necessarily mean that that's the way price is moving, okay? Typically what happens is that it's a fairly strong move that takes it up, okay, that makes that expansion possible. So the steeper the slope you see on the band sometimes, all right, that means that the more the momentum in the move was. And depending upon what type of candle sets up or, how the thing occurred, all right, that could be a prime opportunity for a reversal. And you can see here all of a sudden how the bands were just sort of, ticking down, and then it looked like they were narrowing out earlier, and then boom, we got this candle right here, which really pushed this puppy higher and sent the band, moving up into a more steep slope. Well, now it looks like it's starting to roll over a little bit. All right, you can see the stochastics now are starting to come out of overbought. Right, if we don't get some selling here shortly for me, I might be thinking, hey, wait a second, this thing is setting up to do a little bit of a sideways here before it makes the next push higher. Okay, this could, somebody might say, well, this perhaps is going to look like a bear pennant, or excuse me, a bull pennant, or maybe even a bull flag. All right, so it looks like there's a little bit of support here, and this thing's hanging in there. All right, but we've got a pretty good entry. We're just about flat. We've placed 3 trades. We're down $20 on the day. All right, we have a decent opportunity here to, potentially catch this reversal if this thing happens. Now, if this thing does happen, all right, then I can definitely see us down at 142.50. Okay, we could potentially move a little bit lower to say retest 142. So that's kind of the way that I'm looking at it. But with the bands, slope of the band is very important to keep an eye on because that gives you a read into what the momentum of the trade is. Let's see. Oh, I'm sorry. Not traded for a day while I was not sitting at the screen. Boykie's question is, have I ever just placed trades and I guess not watching it in front of the screen, doing things like placing stops and stuff like that? Yeah, I do that a lot. Sometimes if I'm in a position where, generally speaking, my trades start off from a short-term perspective, and then they get longer term as trades tend to move in my favor. Okay, so if I see something, if I, let's say for example, we just shorted Europe here at 142.75, and let's say that we sit in this and all of a sudden we're right, and this thing starts falling lower, and we get below 142.50, then it sits there and maybe it makes a big move and gets down to 142. All right, well that's a time when I've got 75 pips in the hopper, and I'm saying to myself, hey, let me look at this from a longer term perspective. If I look at a longer term chart, say a 2 hour, or let's even look at the daily here. All right, I might say to myself, hey, wait a second, I think this can retest 140. All right, maybe I want to stay in this bad boy and, see what happens. So, it's all going to be done, evaluation on the fly, but I generally speaking don't like to, come up with these scenarios ahead of time, and if this happens and that happens, you know what I mean? It's more like I'm going to let the market tell me, what's taking place. All right, so it looks like we're putting up a little bit of a fight here with the euro, but you can see this position is generally flat, okay? Not a lot of risk here. Okay, yeah, if the stop gets executed, that's more risk, and that's going to be a little bit of pain for us. All right, but I'm fairly comfortable with where the trade went off at, and we'll see exactly what happens here. Oh, let's see here. Let's see. Example, sitting on my hands. I see what you're saying, Boyke. Do I ever just sit on my hands and not place trades? Yeah, of course. I mean, there's a lot of times when you get patient, especially, in the afternoon hours when the market tends to slow. The only problem with doing that during a webinar is that, well, it's a game of show and tell here, I'm trying to show you things, not just tell you things. So, probably takes on some trades that maybe I shouldn't in the webinars, but it just goes to show you that, you can even take trades that, you're not 100% confident in or you think aren't that great a trade, and it's not going to crush you. It's not going to ruin your day. It's not going to blow up your account. And it's just about, putting in that time and seeing what's happening in the market so that next time you see this scenario, you gain confidence that, okay, this is the time I know when if XYZ happens, maybe this is going to take place. Why does the band look different in, different time frames? Well, it's basically, it's based on, the time frame that you're looking at. It's based on the candles. Right? So if we look at the bands here, okay, you can see on the daily chart for EURUSD, we've been in this nice uptrend, okay, and the band was fairly narrow, basically providing us with a price channel higher. Well, as soon as it started to flatten out here, you can see how the band just started to start narrowing, and once this thing started selling off, okay, the top line started flattening out a little bit, but the bottom line started pointing down. It's almost like it's inviting it to just say, come to me, make your way down there. So the band is going to look different on different time frames based on, what the candles look like. And we can look at this on this 1 minute deal here that I like to use, and you can see the different standard deviations, okay, based on these 1 minute Heiken Ashi candles. So it can sort of show you the places. All right, now look at this here. On the 1 minute, okay, this right here, these candles look like decent reversal candles. So maybe this is going to be showing us a time when, hey, this thing wants to push higher. It may be time to exit this trade. I'm not willing to give up on this just yet, okay, because I think that there's probably still a little bit of resistance here. And again, this is just a very low-risk trade that we put on. So, you know what? I'm willing to take that low risk in order to potentially make that higher reward, And I'm thinking if I am right and this thing breaks down 142.50, then we're going to see close to 142, and that's going to be a much bigger trade, which is going to, be better for the day's P&L. I mean, it's kind of like if you think about it. I mean, I hate to make casino references, because this isn't gambling. But, a lot of times when you talk about, placing trades or placing bets, you're essentially placing a bet with a trade. And it's kind of like, if you want to sit down at that blackjack table, you have to put that chip on the table in order to see the cards, And if you just sat there and put your, your chip down and then you folded as soon as you saw what the dealer got, well, you didn't give yourself an opportunity. All right, you're just giving up that money. But I want to give myself an opportunity for this trade to potentially play out. All right, I don't want to come in and start scalping this thing today because, you start scalping it and you're here for 2 pips, there for 3 pips, and next thing you know, you're having a heart attack and you placed a ton of trades. So right now, I'm just content to let this thing go because I've already come to grips with the amount of risk I've put on, with the amount of potential loss, and I'm saying, you know what, if I lose that, so be it. I've given myself an opportunity to be in this trade and to potentially do better. So, let's see here. What percent of the account do I usually risk? Hard to say. Most of the time, a lot of times I'll trade with a higher degree of leverage for my personal account than I would in, say, a demonstration webinar. Okay, the idea is that, I want to show you different moves based on the amount of pips that we're looking at, not so much the money that you're making. I mean, we're down $20 or we're going to be up 50 or down 60, and, that's not a lot of money in the grand scheme of things. But, what I really look for at the end of the day is how many pips did I do? Because you can use the multiplier effect. I mean, I may only have X amount of dollars in my account this week, but perhaps I'm planning to bring more money back in or taking money out or, whatever the case is. So generally speaking, I don't want to risk, more than that 5% on any one trade. All right, but that's a lot. If you think about that, losing 5% on one trade, that's a pretty hefty amount. So usually I just go by the amount of pips that I'm prepared to lose, and I leave it at that. So, all right. Well, we're just hanging in there. This thing's barely eking a profit for us. All right, but I like the way it's looking here. And I think if we can break down this 60 level, then I think we could have a nice trade in store for us for the rest of the morning here. But it looks like we're starting to narrow up a little bit. I don't see stocks that pull back that much. Okay, so in the next segment of the webinar, we're going to talk about correlations. So I don't know, who of you are going to be in that webinar, but we're going to talk about different correlations, how you can look at different markets. Just to give you an example, I sort of used a correlative play this morning to buy the Aussie instead of buying the Euro after the Euro jumped away from me. And I'm going to explain how that works in a little bit later. I guess we're going to be taking a break here, excuse me, within the next 5 minutes, and then the second part of the webinar is going to start. Question, what stochastic setting am I using? It doesn't seem standard. It's a little bit different, but the numbers are fairly common. I use a 553 setting, Arthur. And the reason I do that is because that's a little bit of a faster setting, and what I like to just a regular stochastic, not the fast, but just a it's not the slow really either, just a stoch. But I like to see more signals than less, and the only reason is because I don't actually use the stochastic to make the decision for me. Like, okay, we're overbought, so I want to sell it here, or we're oversold, I want to buy it here. But rather, I'm using it as a confirmation of what I'm seeing on the chart. So a lot of times, you're going to see trades that, okay, I think I want to sell it. I'm fairly positive. I'm confident in it. Now let me look at the stochastic and see what it's doing. Oh, hey, it's overbought. That's a good thing, So, all right, so we're watching this here, and I guess, we've got a couple of pips in the hopper, which is always nice. But, by and large, when you think about, what you're doing with trading, it all comes back to risk management. And that's the first thing you got to consider. I mean, you'd be surprised how many people I talk to that, sit there and it's always just one big loss that takes them out of a trade, or it hurts the account, or it changes their psychology, okay, because they've taken on too much risk, or they felt so correct about a trade that it was hard for them to admit that they were wrong and end up taking that loss. The idea behind low risk trading is that we're always willing to take the loss, all right, and then we're just going to move on. We're going to move on from there. Keep the loss small, recoverable. You can go for a string of, 5 days in a row of losing and still have plenty left in your account. You can reevaluate what you're doing, how you're seeing things. You can look at it and say, hey, you know what, I've had 5 bad days, but you know what, I'm still in the game. I'm still here. I mean, it's like, if you think about Major League Baseball, a guy gets into a hitting slump, God, look at, someone asked earlier where I am. I'm in New York, I'm a Yankee fan. And it's tough for me to watch, the end of Derek Jeter and Jorge Posada's careers. These guys can't hit the ball anymore because they're getting so old, but they're given the opportunity, to work through these slumps. Whether or not they do remains to be seen. But, it's the kind of thing where, we're all going to go into slumps. But if you can just keep those losses small, okay, keep the risks small, define it ahead of time, then you're going to be much better off. So, I guess that's about what we're looking at here for today. Does anybody have any other questions about low risk, about keeping the pips small, about, anything as far as, placing some of these short-term trades, about the ability to just jump back in and say, okay, you know what, I've reevaluated, now it looks better. Or, it's the kind of thing where, if you keep those risks small, okay, you're going to be around to trade another day. So, all right, gang, I think we're about to go on break here. I guess I'm going to see everybody else in the second webinar. I'm probably just going to keep this trade running here to see. And, catch me next time. I do the weeklies on Thursdays, usually around, I think it's this time, 10 o'clock. It's typically when I'm in the webinar. And then, of course, if you're interested, come check us out at fxedu.com. I run a one-on-one mentor program, okay, for aspiring traders, people who are pretty serious. One-on-one, we'll go over trades, come up with a trading plan, things of that nature. We also have online trading courses that are manned by instructors 24 hours a day, and we've got a whole bunch of good stuff there. So that's what I've got, guys. I'll see you on the next clip.